The US dollar has been the world's reserve currency for over 80 years, dominating global trade, anchoring foreign central bank reserves, and providing Americans with what French Finance Minister Valéry Giscard d'Estaing called an exorbitant privilege: the ability to print the currency the world needs and wants. As of 2024, the dollar still comprises 58% of disclosed global foreign exchange reserves, far surpassing the euro at 20%, the yen at 6%, the pound at 5%, and the Chinese yuan at just 2%. Over $9 trillion in U.S. Treasury securities are held by foreign investors, both official and private, representing 32% of all marketable Treasury debt. The dollar is used in roughly 90% of all currency trading, and until recently was used in nearly 100% of oil transactions. By every conventional metric, the dollar remains dominant, irreplaceable, the foundation of the global financial system. But dominance isn't permanence. The British pound sterling held reserve currency status for over a century before being displaced by the dollar after World War II. The Dutch guilder was the world's reserve currency before that. And history is littered with currencies that seemed invincible until they weren't, that maintained their positions for generations until they collapsed in years or even months. Understanding when and how the dollar might die means looking past official reassurances about its continued strength to examine the structural problems that could destroy it. Unsustainable debt growing faster than the economy, political dysfunction making fiscal reform impossible, adversarial nations actively working to undermine dollar dominance, and most critically, the slow but steady erosion of the trust and credibility that gave the dollar its exorbitant privilege in the first place. The dollar isn't dead yet. But the conditions that could kill it are accelerating, the alternatives that could replace it are being built deliberately by nations that resent American power, and the timeline from dominance to death could be far shorter than anyone imagines once confidence breaks and the cascade begins. The case for dollar immortality rests on several pillars that defenders cite whenever concerns about dollar decline emerge. The US has the world's largest economy, representing roughly a quarter of global GDP, creating natural demand for dollars. U.S. financial markets are the deepest and most liquid, offering investors safe assets that no other country can match. The dollar's network effects, where its dominance is self-reinforcing because everyone uses it, create enormous barriers to displacement. There are no viable alternatives. The euro is troubled by European fiscal problems, the yuan is constrained by Chinese capital controls, and no other currency has the scale or trust to replace the dollar. And finally, recent events like sanctions on Russia following the Ukraine invasion haven't triggered the feared dollar exodus, with dollar reserve shares essentially unchanged at 58% from 2022 to 2024, suggesting fears of dollar weaponization causing reserve flight are overblown. These arguments aren't wrong exactly. They accurately describe the dollar's current position. But they make the classic mistake of assuming the present will continue indefinitely, that structural advantages are permanent, and that dominance can't be lost because it hasn't been lost yet. Every reserve currency in history was defended with similar arguments until the moment it wasn't. The pound sterling was backed by the British Empire's global reach, the world's largest navy, and London's position as the world's financial capital. Yet it lost reserve status within 2 decades of World War II as Britain's fiscal position deteriorated and American power eclipsed British influence. The transition wasn't gradual or managed. It was relatively sudden, forced by Britain's inability to maintain convertibility after the war and by the Suez Crisis of 1956, which demonstrated Britain's diminished power. The dollar faces structural problems that defenders minimize or ignore. The federal debt exceeds $36 trillion, approaching 100% of GDP, and is projected to grow substantially in coming years with no political will to address it through spending cuts or tax increases. The Congressional Budget Office projects debt-to-GDP ratios exceeding 120% within a decade under current policies, levels previously seen only during World War II. But unlike wartime debt that was paid down during subsequent peace and prosperity, current debt is structural, driven by entitlements and interest payments that will only grow as populations age and interest costs compound. The connection between rising debt and declining dollar status is empirically established. As Figure 2 in the Bipartisan Policy Center's analysis shows, the dollar's share of global reserves has fallen noticeably from over 70% in 1999 to 58% in 2024 during the same period that U.S. debt as a percent of GDP has skyrocketed from 38% to nearly 100%. This correlation isn't coincidental. Rising debt undermines confidence in U.S. creditworthiness, raising questions about whether the U.S. will maintain the fiscal discipline necessary to preserve the dollar's value. When Fitch Ratings downgraded the U.S. credit rating in 2023, citing rising debt and growing budget brinkmanship, it signaled that the risk-free status of U.S. Treasury securities, the foundation of dollar dominance, was being questioned. The fiscal trajectory is unsustainable by any honest assessment. The U.S. government is spending roughly $1 trillion more annually than it collects in taxes during a period of economic growth and relatively low unemployment, conditions under which budgets should be balanced or in surplus to prepare for future downturns. When the next recession arrives, deficits will explode to $2 trillion or more annually as revenues fall and automatic stabilizers increase spending. And critically, interest payments on the debt now exceed defense spending, consuming over $800 billion annually and growing exponentially as debt compounds and interest rates remain elevated. This creates an impossible situation. The government must issue trillions in new bonds annually to finance current deficits plus refinance maturing debt. Private markets must absorb this issuance by buying Treasury securities with their savings. But as the debt grows, at some point markets will demand higher interest rates to compensate for increased risk, which will make deficits even larger through higher interest costs, which requires even more borrowing at even higher rates. This is a debt spiral that can only end in three ways: dramatic fiscal reform, cutting spending, and raising taxes to stabilize debt; financial repression, forcing investors to accept below-market returns on Treasury securities through regulatory requirements; or inflation, reducing the debt's real value by destroying the dollar's purchasing power. The first option, fiscal reform, appears politically impossible. Both major parties have constituencies that prevent serious entitlement reform or tax increases. Any politician proposing to cut Social Security or Medicare faces electoral defeat. Any proposing significant tax increases faces similar backlash. And the political system's dysfunction has reached levels where even basic governance like passing budgets or raising debt limits becomes crisis-prone brinkmanship that itself threatens the dollar's status. The regular spectacle of debt ceiling standoffs where the U.S. flirts with default on its obligations is devastating to the dollar's reputation as a safe, stable store of value. The second option, financial repression, is already happening partially through Federal Reserve policies that hold interest rates below inflation, forcing savers to lose purchasing power. But expanding repression to force substantial Treasury purchases by banks and pension funds would face resistance and couldn't scale to the trillions needed annually without destroying financial markets. The third option, inflation, is the path of least political resistance, which is why it's the path most likely to be taken when the fiscal crisis becomes acute. Meanwhile, adversarial nations are actively building alternatives to dollar-dominated systems, not as abstract long-term aspirations, but as concrete near-term infrastructure. The BRICS nations, Brazil, Russia, India, China, South Africa, now expanded to include several other countries, have established the new development bank providing financing in local currencies rather than dollars, challenging the IMF and World Bank monopoly on development finance. They've created the Contingent Reserve Arrangement, a mutual fund providing emergency liquidity to members without requiring dollar reserves or IMF conditionality. More significantly, BRICS nations are conducting increasing amounts of trade in local currencies rather than dollars. India and Brazil have explored settling bilateral trade in rupees and reais. China and Russia conduct substantial trade in yuan and rubles. The trend is accelerating. In 2023, 1/5 of oil trades were reportedly conducted in non-dollar currencies, a dramatic shift from the Petrodollar system where nearly 100% of oil traded in dollars historically. And BRICS is developing a blockchain-based payment system, the BRICS Bridge, that would connect member countries' financial systems using payment gateways for settlements in central bank digital currencies, creating an alternative to SWIFT and dollar-based international payments. These developments aren't curiosities. They're existential challenges to dollar dominance. The Petrodollar system, where oil must be purchased in dollars, has been a pillar of dollar demand for 50 years since Nixon's administration negotiated agreements with Saudi Arabia and other oil producers. If oil, and eventually other commodities, can be purchased in yuan, rubles, or a BRICS digital currency, the structural demand for dollars decreases substantially. And as countries build financial infrastructure that doesn't require dollars, the network effects that make dollar dominance self-reinforcing begin to reverse. China's role in this de-dollarization is particularly significant. China's foreign exchange reserves reached $3.339 trillion in September 2025, representing the largest forex stockpile of any nation. China has been diversifying reserves away from dollars toward gold, euros, and other assets. More importantly, China is promoting yuan internationalization, establishing currency swap lines with dozens of countries, creating yuan clearing banks globally and pushing yuan-denominated trade with Belt and Road Initiative partners. The yuan's share of global reserves remains small at 2%, but it's growing, and more importantly, the infrastructure for yuan-based trade and finance is being built deliberately. The weaponization of the dollar through sanctions, particularly against Russia following the Ukraine invasion, has accelerated de-dollarization efforts. While dollar reserve shares haven't declined sharply in response, suggesting fears of imminent dollar abandonment are overblown, the longer-term impact is more subtle and more dangerous. Countries that fear U.S. sanctions or that simply want strategic autonomy from American power are building alternatives now so they'll have options if sanctions threaten them in the future. Russia's experience, having hundreds of billions in foreign reserves frozen and being cut off from SWIFT, demonstrated that dollar dependence is strategic vulnerability. China, Iran, North Korea, and other nations that could face future sanctions are acting rationally to reduce that vulnerability. This creates a trap for U.S. policymakers. Using the dollar as a weapon through sanctions is geopolitically powerful in the short term but undermines the dollar's long-term status as a neutral, apolitical medium of exchange. The more the U.S. weaponizes the dollar, the more countries have incentive to build alternatives. But not weaponizing the dollar means surrendering one of America's most powerful foreign policy tools. There's no good solution, only a choice between maintaining effectiveness today and maintaining dollar dominance tomorrow. The timeline for dollar decline is the most uncertain variable. Some analysts argue the dollar will remain dominant for decades because there are no viable alternatives and the transition costs are enormous. The euro, the only potential near-term competitor, is constrained by European fiscal problems, lack of political unity, and the absence of a common fiscal authority backing a truly unified euro system. The yuan faces even greater barriers including capital controls, lack of rule of law, and Chinese political risks that make foreign holders nervous about large yuan positions. And other currencies like the yen or pound are too small to serve as global reserves. But this analysis assumes the dollar will be replaced by another single currency rather than by a multipolar system where multiple currencies serve reserve functions. The dollar's share of reserves has already declined from over 70% in 1999 to 58% in 2024. That trend could continue, with the dollar remaining the largest reserve currency but no longer dominant, sharing the role with the euro, yuan, and potentially a BRICS currency or digital currency. In such a system, the dollar's exorbitant privilege disappears. The U.S. must pay market interest rates on debt because foreign central banks aren't compelled to hold treasuries. Trade imbalances can't be sustained by printing dollars that the world needs. And fiscal profligacy faces immediate market discipline through higher borrowing costs and currency depreciation. The transition to this multipolar system could be gradual, playing out over decades as it did with the pound's displacement. Or it could be sudden, triggered by a fiscal crisis, a debt ceiling disaster, or a geopolitical event that breaks confidence in dollar stability. The 2008 financial crisis, which originated in U.S. housing markets and required massive Federal Reserve intervention, could have triggered dollar crisis but didn't because there were no alternatives, and flight to safety actually strengthened the dollar. But the next crisis, particularly if it's fiscal rather than financial, might be different. If foreign central banks and private investors lose confidence that the U.S. will maintain the dollar's value, they'll sell treasuries and diversify into alternatives, causing treasury yields to spike and the dollar to crash. This could create a self-fulfilling crisis where the sell-off itself validates the fears that prompted it. What would dollar death actually look like in practice? The scenario varies depending on whether collapse is gradual or sudden. In a gradual decline scenario, the dollar loses reserve status over years or decades as central banks slowly diversify reserves, as more trade is conducted in alternative currencies, and as the U.S. loses its ability to borrow cheaply because demand for Treasury securities declines. Interest rates on U.S. government debt rise from 4 to 5% to 7 to 8% or higher, making debt service consume ever larger portions of the federal budget and forcing fiscal reform through crisis rather than choice. The dollar depreciates against other currencies, making imports more expensive and reducing American living standards. Inflation rises as import prices increase and as the Federal Reserve faces pressure to monetize government debt rather than allowing yields to spike further. For ordinary Americans, this manifests as declining purchasing power, particularly for imported goods and commodities priced in global markets. The standard of living erodes as incomes don't keep pace with import inflation. Travel abroad becomes prohibitively expensive as the dollar buys less foreign currency, and American assets, particularly real estate and stocks, could crash if foreign investment flees dollar-denominated assets. The wealthy and internationally mobile would protect themselves by holding foreign assets, diversifying into non-dollar currencies, and potentially leaving the country. The poor and middle class would face impoverishment as prices rise and incomes stagnate. In a sudden collapse scenario, the dollar loses reserve status in months rather than years, triggered by a specific event that breaks confidence. The mechanism would resemble a bank run. Foreign central banks and private investors simultaneously try to exit dollar positions, selling treasury securities in dollars to buy alternative currencies and assets. This selling would cause treasury yields to spike, perhaps to 10% or higher, making U.S. government debt service impossible, and forcing either default or Federal Reserve intervention buying treasuries with newly printed money. Either choice would be catastrophic. Default would destroy the dollar's status as the world's safe asset. Money printing would cause rapid inflation or even hyperinflation as the newly created dollars chase goods and services. The practical effects of sudden dollar collapse would be severe and immediate. Import prices would explode as the dollar crashes against other currencies, potentially doubling or tripling the cost of imported goods. Inflation could reach 22 or 30% or higher in the first year. Stock markets would crash as foreign investors flee and as American companies face collapsing consumer demand. Interest rates would spike, crushing the housing market and making business investment impossible. Banks would face runs as depositors try to convert dollar deposits to foreign currency or hard assets. And the government would face impossible choices between austerity that triggers depression or money printing that causes hyperinflation. The social and political consequences of dollar collapse would be as severe as the economic effects. The American middle class, much of whose wealth is held in dollar-denominated assets like homes and 401ks, would be devastated. Retirees on fixed incomes would face impoverishment as inflation destroys purchasing power. And the political backlash against whatever administration presided over the collapse would be volcanic, likely triggering political extremism and social unrest. Countries that experienced currency collapse, Weimar Germany, Argentina, Zimbabwe, Venezuela, saw political radicalization and institutional breakdown. There's no reason to believe the U.S. would be immune to similar consequences. The geopolitical implications would be equally profound. Dollar dominance has been a pillar of American global power for 80 years, allowing the U.S. to fund military operations, foreign aid, and global alliances without fiscal constraints. Losing that capability would force dramatic retrenchment of American global commitments. The U.S. military presence in Europe, Asia, and the Middle East would become fiscally unsustainable. Alliances would fray as the U.S. couldn't afford to maintain them, and adversarial powers, particularly China, would expand influence into the vacuum left by American withdrawal. Some argue this retrenchment would be beneficial, forcing the U.S. to focus on domestic needs rather than global hegemony. But the transition would be chaotic and dangerous, potentially involving multiple regional conflicts as power balances shift. And the international order that has prevented great power war for 80 years, however imperfect, was built on American power enabled by dollar dominance. That order's collapse could lead to instability far worse than any managed decline scenario envisions. The counter-argument to all these doom scenarios is that the dollar's death is always predicted but never arrives, that the structural advantages are real and lasting, and that the alternatives face even greater problems than the dollar. This counter-argument has been correct for decades. But being right in the past doesn't guarantee being right in the future, especially when the structural problems are accelerating. The debt-to-GDP ratio is higher than ever except World War II, and unlike that temporary wartime debt, current debt is structural and growing. Political dysfunction is worse than any time since the Civil War, making fiscal reform nearly impossible. And the alternatives, while still inferior to the dollar, are being actively developed by countries that control substantial global GDP and trade. The question isn't whether the dollar will last forever. No fiat currency in history has. The question is whether the dollar will retain dominance long enough for Americans currently alive to retire on dollar-denominated savings, whether the U.S. can maintain exorbitant privilege long enough to reform fiscal policy before crisis forces adjustment, and whether the transition away from dollar dominance will be gradual and manageable or sudden and catastrophic. The preparation strategies for dollar decline depend on your assessment of timeline and severity. If you believe decline is gradual and measured in decades, maintaining dollar positions with some diversification into foreign assets and commodities is reasonable. If you believe collapse could happen within years, more aggressive positioning is warranted. Substantial holdings in foreign currencies, precious metals, and real assets that preserve value regardless of currency. Minimizing dollar-denominated long-term bonds and fixed-income securities, reducing debt or refinancing into fixed-rate dollar debt that inflation will erode, and maintaining flexibility to relocate internationally if the domestic situation deteriorates badly. The psychologically difficult aspect is that preparing for dollar collapse means acting before it's obvious, which means potentially looking foolish if collapse doesn't happen or happens much later than feared. Someone who converted substantially to gold, euros, and Swiss francs in 2010 has underperformed someone who stayed in dollar-denominated stocks and real estate. But if dollar collapse happens in 2030, the person who prepared in 2010 preserves wealth, while the person who stayed fully dollar-denominated loses everything. It's an asymmetric risk calculation where the cost of being wrong about timing is missing some returns, but the cost of being wrong about the possibility is complete financial ruin. The Federal Reserve and Treasury Department insist the dollar's position remains secure, and they cite real evidence. The 58% reserve share has been stable since 2022. Despite sanctions on Russia, foreign holdings of Treasury securities remain substantial at $9 trillion, and there are no viable alternatives that could replace the dollar's functions. These officials have strong incentives to project confidence because any official acknowledgement that the dollar's position is threatened would accelerate the decline they're trying to prevent. So their assurances must be discounted accordingly. They'll insist everything is fine until the day it isn't, just as Weimar officials denied monetary expansion caused inflation, just as Zimbabwe's central bank denied money printing was the problem, just as every official presiding over currency collapse in history maintained confidence until the currency died. The dollar's death, when and if it comes, will be both surprising and inevitable in retrospect. Surprising because official assurances and the dollar's long dominance will have convinced most people it couldn't happen. Inevitable because the structural problems, the debt, the deficits, the political dysfunction, the rise of alternatives were all visible and accelerating for years before the crisis. Those who preserved wealth through dollar collapse will be those who recognized the warning signs early, who acted before action was socially acceptable, and who maintained the courage to prepare for low probability but high impact events despite being called alarmist. The dollar hasn't died yet. It remains the world's dominant reserve currency, backed by the world's largest economy and deepest financial markets. But dominance erodes, exorbitant privilege can be lost, and the structural problems threatening the dollar are real, large, and accelerating. The debt is unsustainable, the politics are dysfunctional, the alternatives are being built deliberately. And the timeline from dominance to crisis could be far shorter than the decades defenders assume, particularly if a triggering event breaks the confidence that's all that really backs any fiat currency ultimately. Understanding when the dollar finally dies means recognizing that it's not a question of if but when and how, whether the transition will be gradual and managed or sudden and catastrophic, and whether you'll be positioned to survive it or will learn too late that paper currency backed by nothing but government promises and global confidence has always eventually failed throughout history. And that the dollar, for all its current strength, is just one more fiat currency experiment that will eventually end the way all such experiments have ended, in inflation, crisis, and the desperate search for something real to replace what turned out to be just paper and promises from a government that couldn't keep them. If this gave you a new perspective, hit subscribe. The dollar's death isn't scheduled, it won't announce itself in advance, but the conditions that kill currencies, unsustainable debt, political dysfunction, viable alternatives emerging, confidence eroding slowly, and then suddenly, all exist today at scales that would have been unimaginable to previous generations. The exorbitant privilege of printing the world's reserve currency is the greatest economic advantage any nation has ever possessed. But it's a privilege that must be maintained through fiscal discipline, political stability, and international confidence. When those foundations erode, the privilege becomes burden and then curse as the world decides it no longer needs or trusts your currency, and the only question left is whether you saw it coming soon enough to position yourself outside the destruction or whether you trusted too long. Believed the official assurances, waited for proof that never arrives until it's too late, and lost everything to the slow and then sudden death of the currency you thought would last forever but was always just one more historical footnote waiting to be written. The dollar's death will surprise almost everyone. But it won't surprise you. Not now. Not after this. The question is what you'll do with the warning.